Sup Money Masters, welcome to today's video. Last time I spoke about low risk investments. Today we are staying in stream 3 and I am moving on to medium risk investments. In today's video I will tell you when I believe you should consider investments that are medium risk, and I will give you my top 3 preferred solutions or investments that you can consider as a medium risk investment. Let's rock and roll. Okay, let's recap. How do you know if you're a low, medium or higher risk investor? If you didn't watch my previous video on low risk, this will be new to you. Otherwise, it is a short recap. Remember, I always say in all my previous videos, you have to know what you are saving and investing for, which will help you to understand how long have you got to save and invest before you need the money back, and that is called your investment time horizon, which I broke up into you need your money back in the next up to about 3 years, you need your money back in 4 to 9 years, or 10 years and longer. Bucket 1, bucket 2, bucket 3. I also said we've got these gray areas, and that is just when you're moving from one bucket to another. There's no hard and fast cutoff. You have to know yourself. You've got to know what you're saving for. If you need your money back in 3.5 years or 8 years or 9.5 years or 10 years, you still have to make a call in that gray area which bucket you are in. But today we are talking about the 4 to 9 year bucket, which is, in my opinion, your medium risk bucket number 2. Bucket 2. Yes, and remember there are many options. I'm going to share with you my preferred 3 options. And at the end, I'll throw in a little spice as well for when you get closer to the end of bucket 2. In other words, if you're going from about 7, 8, 9 to up to 10 years, in that part of bucket 2, I'm going to add something spicy for you that you can consider. But now, my best 3 options or suggestions for bucket 2 are all again going to be unit trusts. The reason I like this, these unit trusts often have good regulation around them that give you as the investor some protection in certain areas. They all have fact sheets, also called minimum disclosure documents, that you can find some information on and track how the fund is doing and what they're all about. And even if something happens, if there's an emergency, you can always get your money back. Your money is not tied up for, let's say, 7 years or whatever time, investment time horizon you find yourself in within bucket 2. So here we go. My first option is absolute return fund or funds, and I'll explain this, also known as inflation plus funds or targeted return funds. Now this word here, absolute return, if you haven't watched my video that I did quite a while ago on the different types of returns that you get, you can check that out. But absolute return really means the investment manager managing this fund is trying to give you a return of 0 or better. They aim not to lose your money, but that is not a guarantee. And that also comes usually when they'll usually say, we don't want to lose your money, we want to give you a positive 0 or bigger return over every 3-year rolling period. It will never be always or over any 1 year period. but they are managed to protect your money and not lose them. And why I say absolute return funds, under this banner of absolute return funds, they'll all have a target or a benchmark, something they're aiming to provide to you in terms of returns, and that is linked to inflation. Therefore, also one of the words they use for them is inflation plus funds. And you can determine the risk that you take in this fund by looking at this target. So if you start falling into this bucket 2 in the early part, 4, 5 years, you can go for something like a inflation plus 3, 2, 3, 4 fund, maybe 2 or 3 fund. Then you'll get inflation plus 4 or 5 funds, and you may even get the inflation plus 6 or 7 fund, and that you should only consider if you're getting towards the back end of bucket 2. In other words, if you've got about 7, 8, 9 years to invest. But that's an absolute return fund, that's an option, and you can pick different ones in terms of risk, inflation plus 2 or 3, 4 to 5, 6 to 7, and the risk increases because the manager will have to take more risk to achieve a return of, let's say, inflation plus 6. Okay, that's your first option. Your second option, balanced funds. I throw this in here because in South Africa we have a lot of balanced funds. And almost all of them, when you see the word balanced fund in the name, almost all of them are Regulation 28 compliant. That is Regulation 28 of the Pension Funds Act. So these funds, these balanced funds, were specifically designed to comply with Regulation 28, and therefore they fit very nicely into a retirement annuity fund. Go and check out my video on the different types of products you find on an investment platform. Or they fit very nicely into a preservation fund. So go and check that out if you're unfamiliar with those terms. But a balanced fund is a really good medium risk investment anyway. And again, this fund, okay, not again, but this fund won't have a target like CPI plus 3 or CPI plus 7 or 4. But I would say most of these balanced funds over a long period of time, you can go and check out several of the managers who manages these funds. I'd say you can be comfortable with an expectation of inflation plus 4 to 5. But this balanced funds, or most of them anyway, especially in South Africa, are bound by Regulation 28, which prohibits certain things, and that is why I will bring you to my next option, and this is my preferred option for medium risk takers, is the flexible fund. Oh, I love these babies. A flexible fund is very similar to a balanced fund, but it doesn't have any constraints placed on it by something like Regulation 28. And both balanced and flexible funds, absolute return funds as well, but all these products that I've mentioned so far are what we refer to as multi-asset class products. What does that mean? It just means that in each one of them, the appointed investment manager has a range of investments to choose from that he or she will buy on behalf of the fund. And those include things like listed stocks, also called shares, interest-bearing instruments like cash and bonds, listed property investments. These balanced absolute return and flexible funds will almost always, you can check it out on their fact sheet, but almost always, I'd say 99% of the time, have an allocation to offshore assets. So if you're in South Africa, a portion of this fund will be invested in the US and Europe or wherever the manager sees value. So you are diversified by asset class, you're diversified, they'll buy different stocks, different bonds, maybe some listed property. So that's a nice medium risk diversified portfolio, and the reason I like flexible funds the most is they've got no additional constraints on them, and the manager that manages that fund can put their absolute best view of selection of what they want to buy into those funds. And I like that. If you find a good manager and they can put their best views in something like a flexible fund, I like it, and that's why I prefer flexible funds as my preferred medium risk option. Now, what can you expect as an investor in terms of returns from these different options? Let's have a look at that quickly. So if we look at absolute return funds, you have to go and check that benchmark or target I spoke about. They come in those different forms like inflation plus 2 or 3 or inflation plus 4 or 5. And that is a really good indication of what you can expect from your absolute return fund. If we look at balanced funds, I'd say approximately 9 to 11% per annum. What does that get to? Specifically using, again, the South African scenario is inflation plus about 5%. And remember, you are never going to get this in any one single year. Never. Okay? We're talking here at least 3 years and better to expect it over 5, 7 and 10 years. So 1 year your fund will give you plus 3, the other year it will give you plus 12, then maybe a minus 2, then a plus 17, whatever the numbers are. These are not, they work out to about 9 to 11% per annum, but it's not a straight line. I've said that often, so please bear that in mind, and that is why you need to know your time horizon, because these things are volatile, and you need to stay invested so that you can get this type of return. And then flexible funds, I'd still say about 9%, but I think you can get up to 13%. So in our current environment in South Africa, that is inflation plus around 6 or even going up to 7 maybe. But I'd say inflation plus 6. Why? Because there's no additional constraints, and the manager that manages it well can get you a little bit of excess return relative to perhaps an absolute return fund or a balanced fund. So I like these flexible funds. Now the question is, how would I use these funds if I fall into the 4 to 9 year bucket? Let's have a look at that. We're talking about bucket 2 today, and if we just blow up bucket 2, I'd say if you're investing for up to 5 years, I'd go for something like an inflation plus 3 fund, so absolute return fund. I wouldn't get too fancy with too much risk. And then from 4 years, if you need your money back more than 4 years from now, up to 7 years from now, any one of the 3 options, any one of them. You can also select 2 of them. You can maybe have a inflation plus 4 or 5 fund and a flexible fund, 50-50, doesn't matter. You don't have to only have to choose one of the 3 options. You can combine them if you want to. And I would say if you're investing for more than 7 years, up to this 9, 9.5, even up to 10 years here, I would definitely go flexible. And I did say that I would add something spicy for you if you fall in that last tail end of this bucket. You can start to consider if you want to take some equity exposure. And we will discuss equity exposure in the next video, which will be about high risk. But if you already know you're going to fall in this 7 to 10 year type of tail end of the medium risk bucket, you can go flexible fund, or you can go something like 60 or 70% flexible, 30% equity, or 80-20, whatever you're comfortable with. But I would not take this bad boy into this area here. Not yet. Okay, so that is medium risk for today, but just a final warning, the same as I did in the previous low risk video. Final warning, unit trust. I'm suggesting that you consider these unit trusts. If you are contributing to them on a monthly basis via debit order, please always remember that last debit order takes about between 30 and 40 days to clear. So you may want to stop investing about a month before you need your money back, so you can get all of it back at once if you need it. And remember, as always, returns are not guaranteed. Not guaranteed. But if you are disciplined and you stay invested and make sure that you understand your time horizon, then that the returns I mentioned are what you can expect in terms of what you can get back out of these types of investments. And then finally, as I mentioned, the next video will be about the high risk bucket. If you've got 10 or more years to invest, you can also like this video if it helped you. You can follow me on Twitter at MoneyMasterSJ on Twitter, and wherever you see this icon, you can subscribe to the channel so that you get notifications, or if you open YouTube, that you can see if there is a new video for you. Thanks for sticking with me to the end of this one. You are a legend for doing that. Thank you. And I'll see you in the next one. Cheers.